Imagine buying a house which cost 5 lakh dollar. Now imagine paying over 2 lakh $50,000 more simply because your mortgage rate increased by just 2%. Sounds unbelievable. It happens every single day in America. Understanding mortgage rates could you save you tens or even hundreds of thousands of dollars over the life of your home loan. Today I will explain exactly what mortgage rates are, how bank calculate them, why they change, and how you can get the lowest rate possible. Let's get started. What is mortgage? Before understanding the mortgage rates, you first need to understand what a mortgage actually is. Very few Americans can afford to buy a home entirely with cash. Instead, they borrow money from a bank or mortgage lender. That loan is called mortgage. The home itself becomes collateral. This means if the borrower stops making payments, the lender has the legal right to take ownership of the property through the foreclosure. Think of a mortgage like renting money. The bank lends hundreds of thousands of dollars today, and you will gradually pay it back over 15 or 30 years. But borrowing money isn't free. That's where the mortgage rates come in. What is mortgage rate? A mortgage rate is the interest which is charged by the lender for borrowing money to purchase a home. Imagine borrowing a 4 lakh dollar. If your mortgage rate is 6%, you will pay interest every year on the remaining balance. Higher rates mean higher monthly payment. Lower rates means you keep more money in your pocket. Even a small difference matters. For example, a 5% mortgage rate versus a 7% rate could cost well over a $1,50,000 in additional interest over 30 years loan, depending on the loan amount and repayment schedule. That's why Americans constantly follow the mortgage rate news. What is fixed versus adjustable mortgage rates? There are two major types of mortgage rate. First, fixed rate mortgage. Your interest rate stay exactly the same for the entire loan. Whether interest rates rise or fall, your payment stays predictable. Second, adjustable rate mortgage, also called ARMS, adjustable rate mortgage. These often start with the lower introductory rate, but after a few years, the interest rate can increase or decrease based on the market condition. This means your monthly payment could change over time. Fixed rate loans provide stability. Adjustable rate loans may offer lower initial cost but can carry more uncertainty later. What determines mortgage rates? Mortgage rates don't appear out of nowhere. They have been influenced by several important factors. Number one, inflation. When inflation rises, lenders often charge higher interest rates to help preserve the value of the money they are lending. Number two, Federal Reserve policy. Although the Federal Reserve doesn't directly set mortgage rates, it decides on a short time interest rate can influence borrowing cost across the economy. Number three, the bond market. Mortgage rates often move in the same general direction as the long-term US Treasury yields. Number four, your personal financial profile. Bank evaluate your credit score, your income, your employment history, debt to income ratio, down payment. The stronger your finances, the better your chances of qualifying for a lower mortgage rate. Why credit scores matters? Imagine two people buying identical homes, same neighborhood, same salary, same loan amount, but one has a credit score of 790, the other has 630. The first buyer may qualify for a lower interest rate, the second buyer may face a higher rate. resulting in significantly more interest paid over the life of the loan. That's why improving your credit score before applying for a mortgage can have a major financial impact. How to get the lowest mortgage rate? Want to better mortgage rate? Here are the 5 strategies. Improve your credit score. Uh, 2. Save for a larger down payment. 3. Reduce existing debt. 4. Compare offer from the multiple lenders. 5. Lock your rate when the market conditions are favorable. Many home buyers make the mistake of accepting the first offer they receive. Shopping around can potentially reduce borrowing cost and save money over the life of the loan. My final thought is buying a home is one of the biggest financial decisions most Americans will make. Understanding mortgage rate isn't just about numbers, it's about protecting your financial future. A small change in your interest rate today can have a significant impact over the life of your loan. Before significantly any mortgage agreement, take time to compare lenders. Understanding your options, review the long terms carefully, and remember, the best mortgage isn't always the one with the lowest monthly payment. It's the one that fits your financial goals and the long-term budget. If this video helped you understand mortgage rates, don't forget to like, subscribe, and turn on the notification.